Yeah. I thank Kotak Mahindra Bank to give me an opportunity to make presentation on Indian Budget 2022 to NRI customers of the bank. And it is my pleasure to share my thoughts on the Indian Budget 2022. There have been quite a few provisions in the budget, but before I deal with the details, I would like to first deal with the basics of uh, taxation, direct and indirect, as well as the current approach of economic growth through the budget exercise. This is what is very important. So first, let us see what is the background that is developing over last few years. One is that there is a significant change in tax administration in India, in as much as that because of digitalization and collection or gathering of information and data directly, there has been improvement in administration, and there was a focus to ensure that the interaction between the taxpayers and tax gatherer can be reduced. There can be faceless assessment proceedings for taxpayers. And in view of that, the government has introduced in last few years the faceless assessment proceedings for resident Indians. However, this has not been introduced so far in relation to non-resident Indians, but I look forward to that even for non-resident Indians, the same system shall be introduced. And it is very significant that if there is no interaction, there are going to be less hassles and less time and efforts that may be required by the the taxpayer as well as the professionals. However, looking at the current situation, this being a new processes and system, there are teething trouble, but I am sure this will be overcome by the government and things will improve. Further, the digitalization over the last few years have really helped to change over to this kind of system. The second part is that the budgets over last few years have changed their direction, not only for tax collection, revenue collection, but also in relation to economic development of the country. So if one sees this budget from that angle, then one will find that there is substantial impetus to economic growth with substantial public investment in infrastructure like roads, railways, airport, ports, mass transport, waterways, and logistics. Along with this, there is encouragement for private investment, ease of doing business, and substantial push to green energy and digitalization. All this combined together shall lead to economic growth and better revenue collections. The economic growth directly contributes to growth in the value of securities and real estate, apart from benefiting poor people. This is the right policy approach rather than levy of higher taxes, which encourages the private investment. We need to highly appreciate the GDP growth of 9.2% expected in 21-22. In spite of strain of COVID-19 in last 2 years. And I am happy to share with you that the GST collections for the month of January is 1.41 lakh crore in January 2022, which is the highest so far. And there is 40% growth in personal and corporate income tax. I firmly believe that with the contribution from startup ecosystem and the enterprising Indians, we shall achieve aim of becoming economic superpower. Right, the next slide. Yeah. Now, let me run through first the amendments introduced in relation to direct taxes, that is the Income Tax Act in this budget, which is likely to affect all resident and non-resident, but in particular, I am taking it up the provisions or amendments which are likely to affect non-resident Indians. So first is the reduction of surcharge introduced in this year's budget. As you may be aware that on long-term capital assets, which were listed securities, there is a surcharge of a lower amount on the income of capital gains. Now, if we see, there are other assets, similar like real estate, unlisted securities, wherein the present rate of taxation is 37% of tax as a surcharge. However, this was leading to an effective taxation at 20% plus 37% surcharge and education cess, coming to 29%. This is really very heavy taxation on long-term capital assets other than the listed securities also. It is now proposed to keep the surcharge maximum up to 15% on all types of gains from long-term capital asset. So effective taxation is now 20% plus 15% surcharge and education cess. So it is coming to 24%. The effective tax on gains from long-term capital gains like real estate, unlisted securities and other assets shall reduce from 29% to 24%. This is really a great relief to the taxpayers, as well as in India, as you are aware, there is a benefit of indexation and taking up the higher value of asset as on 1st April 2001. Thus, effectively, even this 24% is likely to reduce to maybe 5% or 10% or 15% for many of you who are holding these assets since long. Next, the second amendment in this budget is in relation to updated return, that is revising the return of income. As you are aware, you are normally filing return by 31st July or latest by 31st December. Now what happens? Once the return is filed, the taxpayer is getting 3 to 9 months to revise the return of income in case he finds any defect or deficiency or declaration of lower income. Now, this is a hindrance for him to revise the return on his own. So in this year's budget, now it is facilitated to make corrections in the return of income filed by a taxpayer by extending the period of corrections to 24 months. This will certainly facilitate the taxpayers to revise the return appropriately within the time extended. At the same time, if this is done, then you are likely to avoid receiving any notices from the tax officer or attracting any adverse penal consequences. Now, let us consider who is eligible to file the updated return. The updated return can be filed only in a case where the higher tax is payable in the updated return by the taxpayer. Second is no loss is claimed in the updated return. No additional refund is claimed in the updated return, and any proceedings for assessment is not initiated in relation to this year. Now let us understand what is the provision. Suppose you have filed your return of income at rupees 20 lakhs in a particular year. By chance, after filing the return of income, you came to know that you have not declared an income of rupees 5 lakhs. So you can revise and pay the additional tax on that 5 lakhs of rupees. So what happens? Your tax liability payable by you is income tax on additional 5 lakhs, which you had not declared in the previous original return, plus any interest that may be payable under the normal provisions of the Income Tax Act. Thus, let us take the example that if your income that you are declaring is 5 lakhs of rupees, your tax liability works out to say about 1 lakh of rupees. Further, interest will work out to, let us say, 20,000 rupees. Thus, your additional tax liability shall be 120,000. Now, because of this facility is given to you, the budget provides that apart from normal tax liability, additional tax liability of 1,20,000, you are also liable to pay 25% of tax on that 1,20,000 if the return is filed within 12 months. That is 30,000 extra is payable. If you file the return of income after 12 months, but before 24 months, then you are required to pay 50% of additional 50% of tax interest on additional income, that is 1,20,000 rupees. Thus, you are required to pay 60,000. So, at the cost of 30,000 or 60,000, in this example, you are able to voluntarily comply and save the penalty and protection and get the protection against prosecution for non-filing of return of income. So this is really a very beneficial provision, and it will be very useful for anyone who has missed out declaration of any income in tax return already filed by him. Right. Next. Yes, Aina. Next.
Shantanu, can you take the next slide?
Yes.
Give me a second, please. I just.
Yeah.
Shantanu?
Yes, sir.
Next slide, please, Shantanu.
The next provision in this budget on taxation is bonus stripping. As you may be aware that companies declare bonus, and subsequent to the bonus, various transactions in shares are taking place. Someone may buy bonus shares, someone may sell the original shares, and then someone may receive bonus share and trade in original share as well as the bonus share received. Now, as per the present provision, there was a possibility of creating artificial capital loss. So, in this budget, there is provision whereby this possibility has been plugged. This loophole has been plugged. So, let me explain you how and in what manner this artificial loss was being created and how the benefit of claiming loss against profit was taken. So securities covered are shares, units of REITs, InvITs, and AIF, in addition to the mutual funds which were already covered in this provision. So now what happens in case a company declares a bonus share, let us say 1:1 on 1st January. Someone will purchase the share come bonus on say 5th January 2022. So his cost of share is say market value of acquisition was 2,000 rupees. Once the share becomes X bonus after the record date on 25th January, the market value of the share will be 1,000 because he's going to hold 2 shares. Now the situation is that the present provision requires that the cost allocation to original share is rupees 2,000, the cost at which it has been acquired, and cost allocation of bonus share is nil. Now, people, the person who buys the share, they used to sell the original share, let us say by 31st January. His cost of acquisition is taken at 2,000, X bonus price is 1,000, and short-term capital loss that he will collect is about 1,000 rupees. Thus, effectively, he has no loss because he already holding bonus share, the value of which is 1,000 rupees, but he is holding it. In view of this 1,000 rupees artificial loss which is created was being claimed against capital gain in short-term or long-term capital asset. In view of this, in this budget, this is a right step to ensure that tax avoidance and evasion or manipulative transactions are restricted or not allowed. So now it is proposed that if anyone who has acquired the share within 3 months of the record date for bonus share and sold within 9 months after the record date, then capital loss shall be disallowed. So in this case, if we see that someone has acquired bonus share prior to 25th January, few days before that, and if he sells the share in February, March, that is in period less than 9 months, then this loss shall be disallowed. This is a right approach by the government to plug the loophole. So effectively, it will help all other taxpayers to have reduced rates of taxation. Now, next, there is another amendment in this year's budget that is in relation to cash credit in books of accounts. As you may be aware, the non-residents do take loan or deposit for the purpose of investments or anything, either from a resident in India or even from another non-resident. Now, what happens when he receives this loan or deposit? As per the present law, the recipient is required to explain the nature and source of such receipts to the tax officer. If he is not able to explain this, then the same will be added to his income and is required to pay tax and penalty. Now, it is proposed that apart from explanation to be given by the recipient, even the payer of the loan or deposit also need to explain the nature and source to the tax officer. Now, if the explanation offered by the payer is not to the satisfaction of the tax officer, then such sum is treated as income of the recipient and tax, interest and penalty is leviable. Now what happens? You have received money from someone and he is not responding well to your tax officer to explain the nature and source, then it is likely that you will be adversely affected. And sometimes it is possible that he may be busy, is not available, he may be a genuine person who has given you money, but now the tax officer has been given one more instrument to inquire with the payer. Now what happens? This is going to create hardships to the recipient taxpayer, because he can explain from where he received and give the background. But if the payer do not explain to his tax officer, he is going to be adversely affected on tax liability. So this is very important point that needs to be kept in mind, that anyone who is receiving the loan or deposit from another person, then at the time of receipt only, he should prepare for his safety. That is, he should obtain proper confirmation and document from the payer at the time of the receipt of such loan or deposit, ensuring that the payer has already explained and confirmed that and the same explanation and same documents can be given to the tax officer, so that the tax officer should not create any problem to the recipient. Now, this is a new provision. It doesn't seem to be good for the recipient, but once the provision having been introduced and it may be implemented, finally, the recipient taxpayer need to prepare for protection of his interest and ensure that the payer do not create any problem for him by not responding to his tax officer. Next. Yes, next. Santanu? Yeah. The next amendment that has come in this budget is very interesting amendment. It is in relation to virtual digital asset, that is commonly or popularly known as cryptocurrency. Now, cryptocurrency has become very popular all over the world in many countries. And it is same with India, that so many resident Indians and non-resident Indians have been acquiring, purchasing cryptocurrency. However, over the last 4 or 5 years, there was uncertainty from the government and Reserve Bank of India side in relation to its legalities and manner of doing or carrying on those transactions in India, at the same time its taxation. And because of that, RBI had announced that don't deal in this cryptocurrency. And at the same time, most of the banks were not permitting anyone to do VDA transactions through banking channels or through by opening a banking accounts and trading through banking accounts. This is restricted, and although there have been crypto exchanges, but still there were a lot of restrictions and limitations in carrying on the transaction of virtual digital asset. Now, in this year, government has announced that there is going to be taxation on profit or gain on sale of VDA at the rate of 30% plus applicable surcharge and sales. However, government has also announced few months before that the law shall be introduced to regulate the transactions in India. However, this has not been introduced so far, which is awaited, and it is likely that RBI may come out with appropriate regulations. Then it may be that everyone will able to trade in accordance with the regulations prescribed by the Reserve Bank of India. However, let us examine the taxation of VDA. The tax is to be paid at the rate of 30%. You are allowed deduction for cost of acquisition. However, there is no clarity as to allowability of loss against gain from VDA. You may do two transactions. In one transaction of VDA, you may make profit of 20 lakhs. In another transaction, you make loss of rupees 10 lakhs. One will say that my net income is 10 lakhs. However, it is not clearly provided in the law as put up in the budget that such loss shall be allowed. So we need to wait for any clarification or further amendments in the budget whereby you may be allowed, or if government considers it is not to be allowed, they may clearly provide that loss is not allowed. Further, there is requirement of TDS at the rate of 1% by the buyer of VDA. This will facilitate the government to monitor the transaction of VDA by a buyer and seller, because once the tax is deducted, the person who collects the tax, that is the buyer, will report to the government about the seller who has sold it, and accordingly government will able to track the VDA transaction and implement the taxation provisions and tax collections. Now, having proposed for future transaction from 1st April 22, but one also would like to know what is the implications on transaction and profit and gains of VDA prior to 1st April 22 in last few years in India. So, in my opinion, even when there was no provision, for such taxation, I am of the view that VDA is an asset. If you buy and sell, Indian income tax is very wide. Income is defined in a very wide manner, and accordingly, even for the past transaction, it is likely that if it is came to be known to the government or tax department, past transaction will attract income tax, but maybe not at the rate of 30%, or maybe under the normal provisions of the Act, where it will depend on whether it is a business or capital gain. That is one, whether you can claim set off of loss against profit in respect of past transaction. However, there is no clarity as to past transaction in relation to capital asset or business asset. Further, gift of VDA by any non-resident person to any resident person in India is permissible. It should come through official channel. However, gift of VDA by any resident person to non-resident person, there is no clarity under FEMA, and possibly under income tax also. There are challenges as to its taxation if you transfer from a resident to a non-resident. Plus, it may attract, if it is received as a gift or given as a gift, it may attract provisions of gift tax, that is, recipient will be liable on the market value of that VDA in respect of entire amount at the normal rates of taxation. So going forward, it seems that things are going in a right direction, but we'll have to wait till the regulation is introduced and proper clarity is available for taxation as well as RBI guidelines. Okay, next. The next amendment for in this year's budget is in relation to withholding taxes. Now, all of you are aware that whenever a non-resident purchases the property in India, he is required to deduct income tax at the rate of 1% on purchase consideration. Now, it is proposed that the withholding tax at the rate of 1% on purchase consideration or stamp duty value, whichever is higher. Now, the tax is levied accordingly. So, a minor amendment has been introduced that if stamp duty registration value is higher, then on 1% is required to be deducted by the buyer on that amount, whichever is higher. However, this will lead to some challenges. If you are purchasing a property which is under development from a developer, it is possible that booking of property and registration of property, those timelines or dates may be different. In such a case, there is going to be a challenge that property registration value as of booking date of the property or registration date of the property is to be considered. Accordingly, there is no clarity in relation to this, and there can be a debatable aspect. But in my opinion, stamp duty value at the time of booking to be considered, provided you have proper documentation with you, including allotment letter, etc., so that you can establish that I have purchased the property as on the date of booking, and you will deduct tax at the rate of 1% on the date of booking and payment made on that date. Yeah, next. Now, I want to share one more information for all those non-resident Indians. This aspect has not come into this year's budget. However, all of you are aware that last 2 years, because of COVID, there were a lot of challenges for non-residents who are holding property in India and who are not in a position to come to India for sale and registration of the property, either because of old age, COVID-19, or other issues. Now, if you are not able to visit, one will consider that he cannot sell the property because he has to come to India for registration. However, I would like to share with you that it is possible for a non-resident to sell a property in India without visiting India and register it, without registration by he himself. So what is the procedure? The procedure is that you execute special power of attorney for sale registration outside India, wherever you are located. Further, you also execute all the documents for sale of property which are required for the purpose of registration in India. Once you have these two things, all the sale document as well as the power of attorney duly completed outside India, then you will have to visit a postal services and Indian consulate to get it notarized and confirmed and stamped by both of them. In such a situation, once you execute this and send power of attorney and sale document to India, the power of attorney holder can register your sale of property and then the amount shall be credited to your bank account. You can complete the transfer without coming to India, and that will facilitate you to protect yourself. You can save your cost in an ordinary manner also. So this is really a great facility which is being accepted by registration offices in India. Okay, next. Now, again, there is no amendment in this budget in relation to this slide and the next slide. However, I find that it is interesting that all the non-resident Indians probably have been bothered in last 2 years in relation to obtaining PAN and Aadhaar card, linking the PAN and Aadhaar card. That is number one. Secondly, ensuring that PAN is properly given to the payer of the income so that TDS and tax collection can be done by them. So the government, the finance minister had provided in previous 2 budgets that if you have a PAN card, but if you don't link it with Aadhaar card, then TDS will be deducted at a much higher rate. That is not 5 or 10% or 20%, but double the rate, and it can go up to 30% also, or maybe 84% also. So a lot of non-residents have been bothered about linking PAN and Aadhaar. However, if one considers that the Aadhaar card is can be obtained only by resident Indians as per the Aadhaar Act. So non-residents are not eligible to receive Aadhaar card. And if they are not able to receive, how can they link PAN and Aadhaar card? So accordingly, the requirement has mostly not been complied by non-residents. However, the payers like bankers and others are not insisting if one is not having Aadhaar card. So with this background, what happens that in case of a non-resident, if you have not linked Aadhaar and PAN, you take the stand that legally I'm not eligible for Aadhaar and hence I'm not linking it. Another part is that I find that some of the non-residents have obtained Aadhaar card by declaring as if they are resident in India. They give Indian address and they don't disclose that they are non-resident. In such a case, all these people who obtain Aadhaar card but they are non-resident, in my opinion, this may not be a correct approach or valid Aadhaar card. And if it is not a valid Aadhaar card, the linking may not be appropriate. However, in order to protect yourself, that once having obtained Aadhaar, you have PAN also, for the purpose of your comfort and safety of yours as well as the payer of income, you can link PAN and Aadhaar, you see. So that is what it is. However, so going forward, non-residents are not required to link PAN and Aadhaar. That is number one, because you don't have, you are not eligible. However, you need to submit your PAN. That is what is very important to the payer. But there is one more requirement. One is that all those non-residents who are having permanent established in India need to give a declaration. All those who are not having any permanent established in India need to give a declaration to the payer like banks and others that they do not have any PE. If they give this declaration, then their deduction of tax will be done at the normal rate of taxation. Further, if you have a PE and you are liable to make declaration, then there is one more requirement, that if you are filing your returns for last 2 years, now as per present budget 1 year, then this higher rate of TDS or TCS shall not be applicable. So with this explanation, I can say that all non-residents who have PAN need to share that PAN. Second is that all non-residents who are not having any permanent establishment in India need to give that declaration to the payer. And third, if you have PE in India, you need to ensure that you file your return of income in India in time every year, so that there is no requirement of deduction of higher TDS or TCS by the payer of the income. Yeah. Yeah. Next, I've covered this slide together. Now, friends, no, next slide. Now, friends, what has happened that the provisions which were relevant for non-resident in India have been covered by me, and it is possible to ensure that and share my views on the benefit of double taxation treaty to be availed by non-resident Indians. All of you may be aware about this, maybe claiming it, but I thought that if I take it up today, it may be useful. So let me start with this slide, relevance of DTA. An individual who is resident of a foreign country and he is also is non-resident in India, he is earning income in India, and this income, and he is also earning income in the country of residence. Income in India is taxable in India. However, it is also taxable in the country of his residence because of the provisions of Act, that wherever he is resident, he is required to declare it as income. In view of this, a person who is resident outside India and earning income in India is liable to tax on his income in India in both the countries. Naturally, with this background and having additional tax liability, the governments of different countries have entered into double taxation avoidance agreement, which provides, as you will see, which provides that there has to be facility of non-double taxation in relation to such persons. So the relief is given by way of complete exemption of income, lower rate of withholding taxes, underlying foreign credit, and tax-paying credits, which I will explain you in the next slide. Now, let us see. The income in India earned by a non-resident. What is the indicative basic rate of tax in India? First, we take up NRI, FCNR deposit. It is totally exempt. If the rate of tax on this interest in the country of your residence is 40%, you are required to pay 40% in that country, say US or UK. There is no taxation in Middle East. However, you cannot get any tax benefit because there is no double taxation. There is no tax in India, so there is no double taxation. But there are some countries which give tax-sparing credit on an assumed rate of taxation. So if I explain you, Australia and UK, they give some credit for tax, even if it is not paid in India in relation to NRI, FCNR amount. So there are terms and conditions and provisions, but let us say that if UK grants credit of 10% of tax in relation to NRI, FCNR deposits, then the tax liability on interest on NRI, FCNR shall reduce from 40% to 30%. There are few countries which give this benefit, and it is really very good for the resident of that country. If we see next implication, NRO deposit. What is happening? Indicative tax rate, basic rate in India is 30%. The rate of tax in other country of your residence is 40%. So lower rate of taxes. So how the relief is granted under the double taxation treaty? So relief is granted by giving low rate of taxation in India. That is, you pay only 15% in India, and further, whatever you pay in India, that is 15%, shall be available as a credit in the country of your residence. So effectively, you will pay 40 minus 15% in the country of your residence, that is 25%. You will pay 15% in India. So your overall taxation shall be 40% and no more than that. So I am not, since there is a time constraint, I am not taking up the example of rest, but the basic fundamentals is this, and it is actually explained in my subsequent slide, directly connecting to actual taxation by 5 different countries. So if I explain you there, you may able to grasp it better. So next slide, Santi. I'm sorry. Okay, so now if you will see here, let us think of investments in India. You have investments in fixed deposits in India, NRO, NRE. Tax in India is exempt from tax and 43%. Interest income from NRO account is 43%. It can go maximum. Now, what has happened? Tax implications in US, UK, UAE, Singapore, and Mauritius is explained. Under the double taxation treaty between India and US, India, UK, it is prescribed that India shall not tax more than 15% on interest income from NRO. That means the NRI is liable to pay only 15% tax on NRO interest. If the person is UAE resident, he is liable to pay only 12.5% and 15% for Singapore and Mauritius 7.5%. Thus, the actual benefit of by resident of these 5 countries in relation to interest income from NRO account is substantial, that not 43% or 30% or 25%, but it gets reduced to this rate of tax. At the same time, the person will get credit also, that if he is a resident of US, he will get credit of this 15% in US, UK, etc. There is no tax in UAE. That means you cannot claim any credit of 12.5% in UAE. The same thing is explained in relation to double taxation benefits in respect of securities other than shares. There are listed securities other than shares and unlisted securities. Generally, short-term capital gain and long-term capital gain is payable in relation to listed security in the nature of equity-oriented mutual fund. So, short-term rate is 43% or 18%, and long-term capital gain rate is 24% or 12%. What happens to a person who is resident in US and UK? That whatever tax is paid in India shall be available as a credit in respective countries from his liability to pay tax in US and UK. So that is a benefit of double taxation treaty. However, it is interesting to note that the income from equity-oriented mutual fund, short-term or long-term, which is listed on Indian Stock Exchange, is not at all taxable under India-UAE Treaty or India-Singapore Treaty or India-Mauritius Treaty. This is a very interesting information for the resident of these countries who can claim total tax exemption for their investments in equity-oriented mutual fund in India. Now, if it is unlisted securities other than that, then also if it is short-term or long-term, the same application of tax treaty benefit is available. Another thing is that income distribution from mutual fund. So what happens? Mutual funds declare dividend, and if you receive dividend on mutual fund, then it is likely that you pay tax in India at 29% for non-resident. However, if you are resident of US or UK, whatever tax that you pay in India on this dividend will be available as a credit in UK and US. However, as far as UAE is concerned, it is not at all taxable in India and hence no need of any credit. Similarly, tax credit will be available in Singapore and Mauritius. Now, let us come to shares, listed and unlisted. As far as listed shares are concerned, equity shares is taxable in India, short-term capital gain at 18% and others 43%. And long-term capital gain is payable at 12% and others at 28%. So if you are resident of all these 5 countries, you will get credit for taxes paid in India from your income, from your taxation in respective countries. Now, more important part is dividends from shares in Indian companies. So what happens? Which are the non-resident is paying tax on dividends at the rate of 24% in India on dividend income earned. Now what happens that if the recipient is resident of US or UK, in UAE, Singapore or Mauritius, it is provided in double taxation treaty that he as in India, the tax payable shall be either 15%, 10% or 5% in a case where the non-resident is holding less than 10% of equity share in the company. And if he is holding more than 10% of equity share in the company, then US will charge 25%, US will charge 25% and UK will charge 10%. However, whatever tax that is paid shall be available as a credit in respective countries. Now, let me check, because Mr. Sainath, we had some time constraint, to complete the presentation.
If the presentation is through, we can go for the Q&A. And I think we'll need some time for queries also because there are a lot of queries which are coming in.
Okay, all right. But, okay, all right. I am fine with that. But since I wanted only 1 or 2 minutes for next slides, that's it,
Definitely.
So that that will be very useful to those persons who are resident in US. So friends, those who are resident in US, if you see the lower half of the this slide, that if you are selling any real property in India, whether it is short-term or long-term, and other than real property, so if you are selling real property, the tax rate in India can go up to 43% for short term and 20 to 24% for long term. Now, whatever I've explained you so far, you find that the credit should be available in US in relation to the taxes paid in India. So if US tax rate is 37% on short term, you have paid 43%, then you will say that give me credit of at least 37% in USA. And also for long term, you give me credit against 20% payable in USA. However, because of the typical provisions of giving credit between India-US tax treaty, the tax credit for real estate taxation paid in India is available only at the rate of 50% of taxes paid in India. This is an approximate figure. So in case of a long-term asset in India, you have paid 24% as tax in India. You are liable for 20% in US, but you will get, sorry, you will get credit for 12% only. So you will pay 12% in India and you will pay 20% in US. So to that extent, any sale of property in India by US residents they are not getting full benefit of tax paid in India under Indo-US tax treaty. So this is something one has to keep in mind, that they are liable to pay additional taxation. Right. So now I think I would like to close at that, and we can go for question answer, Sainath.
Thanks, Kirit bhai. I think you have a very good way of explaining the difficult subject very easy. I think. Thanks so much. I think a lot of queries, so I will ask a few queries, and then maybe if our clients still have some more left, they can raise their hands and we'll allow them to even ask questions. I think, Kirit bhai, I think few things what our clients wanted to know is which NRI is required to file returns in India. So if someone has nil returns, a very negligible income which they make in India, are they required to file returns here?
Let us bifurcate into two parts. One is that one who is having capital gains in India, short-term and long-term. So any non-resident having short-term or long-term capital gain in India, he is required to file return of income irrespective of any income, any amount. Even if your income is say 5,000 or 20,000, you are required to file return of income in India. Second is that, or there are three things. So second is that if you are entering into certain transaction in India, whether you have earned income or not, like traveling expenses or electricity expenses paid in India beyond certain amount, 1 lakh of rupees, this prescribed transaction, if non-resident has entered into, then irrespective of his income, maybe his income is nil, no transaction at all, but he is required to file return of income. And third is that other category, that someone is having only NRO interest income, no other income, or other income which is less than 2,50,000, but other than the long-term, short-term capital gain, then the person is not required to file return of income is if such person's income is less than 2,50,000 rupees.
Okay.
Yeah.
But even in that cases, you will say that to have a reduced TDS, they would still need to give the declaration to their bank and other things. Because if they don't file returns for 2 years, would that impact them?
Yes. So it is necessary for them to give a declaration in that form F and G. That is better, so that bankers can comply with those provisions. Yes, that is important. You see,
Kirit bhai, this budget had a provision of allowing a voluntary filing of updated returns up to 24 months. Now, is it only for voluntary? What if there is a return filed and the authorities raise a query on this? Can the voluntary return be filed again, updated return be filed within 24 months, or it's allowed only if queries are not raised?
So what it is prescribed in the amendment that in case if some tax proceedings have been initiated in respect of this year, notice have been issued and inquiry is being made, then you are not allowed to file belated return or revised return.
Okay. Kirit bhai, there is one more provision of actually having to do enhanced due diligence on cash credit transactions. So if you're taking a loan from somewhere, earlier it was just finding out, giving the details of whom you've taken the loan. Now you have to take. One of our clients wanted to know what additional documents are required. How would the authority be satisfied that you've done your due diligence right?
Yeah. So normally what happens, the normal documents, which in my opinion is sufficient, is you take the PAN number of the person, you obtain confirmation letter from the person, and you also obtain his bank statement. If he has filed the return of income, also obtain the confirmation on that he has filed the return of income. If he shares it, it is very good. The other part is that while you are asking for confirmation from him, it may be useful if you are able to ask him to put the source of his money from where he has given you the loan. Say his bank statement will show that he has received 50 lakhs from sale of property, and out of that 50 lakhs, he has paid you 25 lakhs. So the source of 50 lakhs is sale of property. It may be useful if he is putting this in his confirmation letter that my source is sale of property or having received it from some other transaction, and this supporting also can be given by him that I've sold the property at so and so address, and the registration document can be available at that place. So this type of documents will be strong enough and good enough. Now what happens? This is the provision introduced in this year. So far, we were taking all those documents from the payer of the loan and representing it to the tax department. However, now what has happened that you don't have much of scope of explaining to the assessing officer on behalf of the payer. Assessing officer may say that I will believe what payer says. I don't want you to be involved. Now, this is something which will create hardship, and I believe that this is not probably a provision which can be accepted under the provisions of law. I say that one can challenge that how do you believe the payer and not me? You know, that is what is very important, because sometimes there is always some clash between payer and recipient, and payer may think that he is trying to harass me, recover money from me. Now, I will not cooperate with his tax officer and let him pay taxes and penalties to the tax officer, litigate, etc. So I am of the opinion this is not a sound provision of law unless there are some guidelines also issued or rules are also made on this.
Yeah, not. I think things are not very, very easy if you're alone.
Yes.
One more query. In fact, a lot of our NR customers book a forward contract against the FCNR so that, of course, they get higher returns. So what is the taxation on the forward contract? Is there whatever they make over there? Would you be able to throw some light there?
Well, this is a very, very debatable question, and we do have examined it in the past, and we find that it will all depend on the documents or contract that you have entered into. You see, because what happens that there is document, both the documents which will show that someone has gained and how much gain is available to you, and it is on account of contract between the bank and the client, and this contract may attract or show that there is some gain to the person. However, this is not free from doubt, you see, because what person earns is he has deposited foreign exchange, he is getting it converted at a particular rate as per the contract, and that is what is agreed between them. There is nothing like sale or anything. I don't think so. It is merely conversion of foreign exchange into Indian rupees. I find that personally it may not be taxable, but it's a very challenging proposition, and I will not able to guide you very clearly about its taxability or otherwise.
Okay,